Hello everyone, welcome back to my YouTube channel. This is Bahram with Salzgar Electric. In today's video, I kind of wanted to just quickly touch on how I deal with investing and making sure that you have the right mindset when it comes to investments. Because it's one thing to be able to invest in the stock market, invest in different things, but there's a whole other story and a whole other way of thinking about and having the investor mindset. So let's get into the video. So the point number one that I want to make here is that investing is a long term mindset. So a lot of people confuse investing with like trading because they're comparing it to gambling, and they're thinking just because investing is a form of gambling, which is not true. Because when you're investing, a true investor takes their time, looks at a company, and a lot of people like kind of talk about this as well. You're not buying stocks, you're buying a piece of company, however small that piece might be. You're still buying shares, you're becoming an owner in that company. Now if you think of it like that, imagine you're going to be investing in a local laundromat, right? You're not going to be going in, giving them $1,000, the next week going and cashing that out. Doesn't make any sense, right? You're going to be looking at the who's managing it. You're going to be looking at their lease. You're going to be looking at their customer base, their sales, their market share. You're going to be looking at as a business, like you're buying into a business. And when you're investing, that's the way that it really should be. Because if you're not, then you are trading, you are gambling, because you don't know how that's going to end up. You don't know what you're getting yourself into, which then it makes sense. You are gambling. So that's point number one. Make sure that you're having an investor mindset, and an investor mindset begins with a long-term mindset. And that's really point number one here. Point number two, which I slightly touched on already, is that trading, you could look at trading as gambling in a sense. Now, there's a lot of people that study the markets. They have different technical analysis that they do, on the charts, and on different, they do swing trading. They use mathematical type of like Fibonacci and things like that, and all that is good, and some do very well for themselves. The thing is, unless you are in that niche and you have studied it the best that you can, obviously you have really like tone it down and you have become a professional at that, even then you're still losing money from time to time. But your chance of making money that you might see on TV, or you might see from other people, that is doable then, because then you're really into it. And you have to be like watching the stock market. You have to be, like you see maybe on TV, people sitting in an office, maybe having two, three, four, five monitors and watching the stock market, watching the news. And again, there's different types of traders, and it really depends which one you want to be getting into. There's nothing wrong with it. I'm not saying that that's absolutely the worst idea. You're never going to make money. I know gamblers that make money at the casinos, right? But it is gambling, right? Because you're not really creating any kind of value. You're not holding anything to see the proper appreciation of that company. You're really just looking into making gains from the stock, from the chart. If there's like a dip, you're gonna buy it, and you're hoping it goes back up to resell. It might be trading options. So there's different things, right? But really, understanding again from point number one and two is that which one is an investor, which one is a trader. If you don't know what the differences are, that's where you get in trouble. If you know the difference, that's okay. Then you can pick and choose and go with whatever works for you. But making sure you know the difference is the most important part. So that's point number two. Now that we have that out of the way, point number three is going to be really studying the market and studying the companies that you are buying. It's very easy to come and say, let's say, Costco is a big company. I'm just going to invest in Costco, right? In the long term, it might be okay, but again, depending on your, how long that long term is, there's still some big companies that do, go bankrupt, or actually, they might get consolidated and they might close down, right? So, there was like Kodiak back in the day. There was, Sears, Hudson Bay. In Canada, these are again bigger companies that if you would have just closed your eyes and say, "I want to invest in that company," you would have lost your money, right? So even though there are big companies out there, the majority of them will do fine. You still want to do your due diligence, because again, when you're doing direct investing, meaning that you are managing your own money, you make your own buys, you make your own sales, there's no advice in it. right? So you're doing your own research from 0 to 100%, right? So you want to be liable because you have worked hard for your money, and investing is a part of your financial growth and your wealth accumulation. So you want to take it very serious, right? You want to study as much as you can on it. You don't have to go to school for it, but as long as there's a few really good books that if anyone is interested, I'm more than happy to recommend the books that I've kind of read and studied, that I feel comfortable enough to manage my own funds, because it's not an easy thing. It's easy to get scared when the market takes a dip, which it always does. It's easy to kind of get scared and sell, right? So some of it is psychological when it comes to money, some is more emotional, and some are just the investment philosophy that you need to create for yourself. Because at the end of the day, even if someone gives you the best investment kind of strategy, if you get scared and you want to sell when you're supposed to keep or even buy more, let's say at that time, then it's useless, right? So you want to make sure that whatever that you're comfortable with, you're able to come up with that strategy and stick to it. Of course you can adjust it and make adjustments to it, but the principle that you have for yourself for investments and having that investor mindset, that needs to stay intact, and you cannot change. Let's say from going to investor mindset to a trader mindset, and you're still wanting to you be an investor or be a trader at the same time. Now I know some guys that they do a little bit of both, right? So they have a portfolio that they're investor, they're holding that, they bought a lot of shares in different companies, and they're kind of managing that. But again, they're more passive with that, and they're not trading it, and they have another account for trading. And yeah, and that's fine too, right? And there's no right or wrong here, but understanding, like I said, understanding the difference between them is the biggest point here. Because it's very easy to come out and say, yeah, I'm an investor, but then you bought 100 shares of Costco, and then something happens which is not related to the company. It might just be the economy as a whole, and it just takes a 10% dip, 20% dip, right? Because of like COVID-19, because of something with a war or something like that is happening, or whatever it may be, right? Because of that, you right away go ahead and sell. You just prove to yourself that you don't have an investor mindset, and you don't have a long-term mindset, right? And you have to be careful with that, because a lot of portfolios just wiped out this way. And again, it's your own hard-earned money that you're putting into these funds, into these investments, and you want to watch it grow for yourself and your family and for your next generation, if that's part of your financial plan. So you want to be careful with that and keep that in mind, and keep learning and keep understanding what it is to be an investor. That's the important part. Number 4 point here is that setting up reinvestment to be automatic. In Canada, one thing we have here is called the Dividend Reinvestment Plan, or DRIP. And this is something that when you set up your direct investing account with any financial institution, they're going to ask you if you would like to enroll into this program. All it is that, let's say you are buying your, Costco, McDonald's, the big banks here in Canada, for example, or any, even US companies as well. When they pay their monthly, quarterly dividends, most of the time it gets automatically deposited to your brokerage account, and it stays there as cash. Seldom we see that they actually send you a check, but I know some older companies still did that. But the majority, probably over 90% of them, 95% of them, they actually just deposit that cash into your brokerage account and just sits there as cash. So you have to go back, and then once it accumulates, so whatever it may be, 100, 200, 1,000, you can go back and purchase whatever else company, or even the same company as you want. And of course, every time you purchase or you sell any stock, whether it's one share or let's say 10, 50, 20 shares, doesn't matter how much the value of it is, you have to pay a commission, and it's just a trading commission. The majority is just under $10. It's either $9.99, $9.95, but you pay that every time. Now, when it comes to this DRIP, or dividend reinvestment plan, the benefit of it is if the dividend that the company pays you at that time, if it's enough to purchase at least one share, it will do that automatically. If it's enough to purchase 1.5, it will only purchase you the one. You can only purchase one whole share, right? So let's say the stock is $100, but your dividend pay is only $99. It's not going to buy you the stock or buy you that one share. And let's say it's $100 and the pay is $198. Even though it's $198, is almost two, enough to buy two, but At that moment, you can only buy one whole share. It will only purchase you the one whole share, and that's automatic. It automatically happens every month, every quarter, whenever that company pays that dividends. The main benefit with that also is that when it does purchase you that one share, it does it at no extra cost. So you actually don't pay that buy commission of $9.95, and that's a very good accumulation type of strategy. So let's say, if you're buying, let's say that Costco shares you're buying, and every time you save enough, you purchase another one, you save enough, you purchase another one. Because I know it's right now, I don't know exactly, but I think it's close to $1,000 per share, US, of course. And so let's say your dividend is enough to buy you one whole share, and then it will go ahead and do that. And then of course, next dividend payout, because we have that one extra share, is going to be a little bit more of the dividend payout, right? Of course, with your own money kind of putting into it and buying as well. And over time, that kind of snowballs, because that dividend grows. So then you get more shares, it does more dividend repurchase for you, and you get more shares and you get more dividends, and you put your own money. It just grows and grows and grows. So that's a very good strategy to have, again, for an investment and investor mindset. It's a really good idea to take advantage of that, especially if you are younger, so you have a lot more time to let that kind of snowball for you. This is not the main part of your investment strategy, but it's a very, very good, powerful tool, because it does snowball, and of course it kind of generates more income for you. And eventually, when you do want to use that dividend and not reinvest it, you can stop that plan, and you could just keep that money as cash, and then be able to withdraw it. And then depending on your taxes and all that, you pay that, but then still you could put that in your pocket, and you could actually use that money maybe down the line if you want to use it. But if you don't have time, and let's say you're in your 20s or 30s, you're not going to be touching that for now. You could let that snowball over and over and over, and all these years that will pass. And of course, you still need to keep that stock, to keep those shares. It's just going to keep growing for you over and over and over. So very powerful tool. It's called the DRIP, or dividend reinvestment plan. You should look into it. Now, point number 5 that I want to talk about here is going to be sometimes a lot of people get into what's very hot right now, or what's very popular right now. And I like to always think of investing as being boring. It's a very boring thing to be an investor. That's the way that I think of it. Of course, it's not, but that's the way I think of it. Because if you think of it as something being very exciting, you want to be into whatever everyone else is kind of talking about and doing, then what's going to happen is that you're going to start investing into things that you know nothing about, you do no research on, and you just get into it just because you're hearing other people get into it and making money, or other people buy it and they want to hype it up, so they make you feel like it's a good idea to buy it. And now, of course, if you do your research and you're comfortable with the investment strategy and with whatever principle you set up for yourself as an investment strategy, then yeah, you can go ahead and invest in it, right? But if something that you don't understand, and is something especially that's very hot and everyone is talking about it, you should definitely take a step back and really see what that investment is. Now, one example that I can give for myself is Bitcoin and all this whole cryptocurrency. Of course, there's a lot of people that have made a lot of money in it. A lot of people got frauded, so a lot of people lost money in it, but that's a whole different thing. But for myself, when it came to Bitcoin, I mean, I'm not very techie myself, but even except for that, I never really understood how Bitcoin worked, how the cryptocurrency worked, and I was never comfortable with it. And again, just because I saw it as a very risky thing. A lot of people were making money in it. There were a few companies that got frauded, that the website, like all this money that was deposited into that site, I guess, the company got shut down, and the owner went missing or went away, or they said it was dead. I don't know, but there's a lot of stuff that went around with it, so it just kind of really made me not want to get into it. And now it doesn't matter, like if I would have made money and stuff. That's not the point. The point is you have to understand what you're investing in. Let's say if I'm comparing in this scenario Bitcoin with Costco, right? It's very easy for me to sit here, go online, do the research, pull up financial statements, their quarterly statements, and financial statements year over year for Costco, going back to so many years, and I'm able to kind of look at that, see their numbers, see their revenue, their cash flows, look at the CEOs and their board of directors, see who's running the company, how they're running the company, what's their track record. And that's the investment process, because again, like, I'm buying into that business. I'm looking at it as, let's say I was going to become a partner with someone, I would look at the track record and kind of see what they've been doing, and if it makes sense for me to put money in them, kind of with them, to whatever business that they're in, right? Like, let's say if you're comparing that then like that Costco to Bitcoin, I would 100% get into Costco way more than I would get into Bitcoin. And even for example, Warren Buffett, there was an interview he did regarding like getting into like, like even Microsoft and Apple. He didn't understand how those companies made money. He didn't, he wasn't really into something like that, so he didn't understood it, so he never invested in it before, right? Now of course you could go and say now you missed out on maybe like millions and billions of dollars, but as long as you understand your own investment strategy and what you're comfortable with, then that's okay, right? I mean, it's not okay when you miss out on the investment and you look at it later on. But then even if it was something that, it would have gone down or when I've gone bankrupt, no one's going to go and say, oh yeah, good job, you didn't invest in it, right? But when you mess up, people want to point it out, right? So that's, but in any case, I always look at it as what makes sense for me. What do I understand? Because at the end of the day, anyone else, could invest in it. It doesn't matter. I don't just follow whatever else someone tells me. I take it as a as a hint, and I'll be like, okay, so you're talking about this company. Okay, let me go look at it. Right? I'm not just gonna go log into my online account and just buy shares in it, and that's what I mean. You shouldn't be doing. I'll still go look at it. I'll look at the company. I'll do as much research as I can, and then as much research as I know that I can understand. Of course, it's way more complicated than what I know. But I feel confident enough after my own research that I put money in. Now again, even with that, you could still lose money. Company, still goes through a bad time. But the majority of the time, if you're buying into companies that are good quality and they have good financials and they have proper CEOs and proper systems in place, that one thing that also Warren Buffett says is that from time to time you might have a monkey running the business, right? But if the company, the corporation has good systems in place, even if a monkey is running this, it could be an idiot running this company, the company will still make money. Now, of course, with that being said, even the CEOs could make statements or do something in public that could draw down the stock price at for a week, a month or so, or get into lawsuits because of something they did, something they said, with different things right now that's going on in the world. Anything you think could be very sensitive. You have to be careful with that. But still, you could do something that could really affect the company and like the stock price, right? And again, those will be short term. Like I mentioned, it could be a week or a month, and then eventually we will level off and go back to normal. And sometimes they have to like fire the CEO to like make everything gonna go away, sweep it under the rug kind of thing. But still, it's very important to look at that and kind of understand that there will be companies that you'll buy even as an investor that they might do very well. They're gonna have strong growth, strong sales, strong revenue. They're cutting back on expenses that they kind of like going through their whole business restructuring. But again, if they have a CEO that's gonna be outside in public, say something stupid, do something stupid, it could ruin all of that, right? But again, short term, it won't be long term, because the sales revenues long term, they will reflect in the stock prices. If they're increasing their revenue, a big company, they might increase their revenue, let's say $100 million per year. Even if the CEO goes out and does something stupid for a month, 2 months, it might be down. Eventually, when they do the quarterly announcements, quarterly reporting, and the analyst looks at that and kind of like does their own pricing, and then the numbers come out, the report comes out. If it does very well, obviously the stock's going to go up again, right? And again, there's another way a lot of people do trading. They look at companies that are in short-term drawbacks. So let's say they were at $100 per share. CEO did something stupid, something's going on, there's a lawsuit, it goes down to $80 a share. A lot of people use that opportunity to buy in because they know the value is $100 per share, but because of short-term issues, problems, whatever it may be, is down at 80. So a lot of people even use that to kind of do their kind of trading or investing, if you will, right? But again, it depends how much you want to be into it. If you're a full-time investor, you have a lot of money, you just sit at home and trade and invest, then of course you could come sit down, look at the kind of stock market on a day-to-day, Monday to Friday they're open, kind of do your trading, investing, whatever it is. But for the majority of the other people who have other jobs, other careers, running their own business, they don't have that time, right? So it kind of goes back again to what you want to accomplish and what you want to do. But one thing, even back when I was working at a financial institution, a lot of people, especially younger people, that would ask me if they should be getting into the stock market, how does trading work, how does investing work, and going back to thinking it's like a gambling, and they should only do it with their extra money that they put away. One thing that I would recommend for them is that of course, if there's any free trading softwares, if they want to kind of if they have a trading strategy they want to like kind of use, that's always kind of good to kind of try it out and kind of see how it is. But of course, when it's real money, you may not be making the same kind of trades because you know it's extra risky, right? When it's just play money, you don't mind, but when it's going to be your real money, you may not actually even do that strategy that you were planning to do. But one thing I would honestly say is, if you really want to do trading and you want to do investing, do both. So have your fund split up, again, whatever you're comfortable with. Let's say from a percentage kind of like view, let's say you take 75% of the funds that, again, you want to put aside and invest, right? You take 75% of that, 70-80%, whatever your number you're comfortable with, you take that and you do it as an investment, long term. You're buying companies, holding these companies, you're thinking of the DRIP, dividend reinvestment plans, you're looking at all of that, and you take the other remaining 20-25%, whatever it may be, then you can trade with that. And and if you want to think of it as gambling, then that's okay. You're just gambling with only a certain percentage, small percentage of your funds. And that way, you can't really like lose all this money that you have saved. You worked, you saved, you put aside, and just lose that money just because you made some bad trades, right? So think about that. Make sure that whatever strategy that you come up with is matches whatever you are going to be actually doing. Meaning that, again, if you're going to be thinking as a gambler, that's okay, but understand that it is gambling. If you're trading, doesn't matter how much technical analysis again, like I was saying, a lot of professionals that even make a lot of money, still they have, if you look at the trades over the years, they might have, it might be at 50%, meaning from the 100 trades they make, 50% of them they lose, the other 50% they win. So they're hoping for maybe 51, 52, 55% of the trades to win. So then averaging out, they're making money. And it doesn't mean if you're an investor, you're going to be making money right off the bat, right? Let's say you buy shares of Costco, McDonald's, here in Canada, the TD Canada Trust, RBC Royal Bank, one of the few big banks here. If you're going to be investing in those companies, when you buy it, whatever share amount it is at that time, $100, $200 per share, it could go down. It could go down from 100 to 80 and stay there for a year, for example, right? Or you might they get into a lawsuit, again, there's a temporary dip, right? So all this stuff, I'm not saying that just because you're an investor right off the bat you're going to be making money, but what I'm saying is that having that mindset and understanding that is a slow process, right? It's not overnight. It's not a get rich quick here. It's over time. You're saving your money, starting with whatever you can. You can only save $20 a week, $20 a month. You start with that. You build up the habit. Again, I have another video on savings, but you have to build up the habit. Savings is a habit. It doesn't matter what the amount is. And that's what a lot of people don't understand. Because in the beginning, of course, let's say you're in high school, you just out of high school, you might have a college degree, may not. You're starting somewhere between minimum wage to a little bit higher than minimum wage. So it's not going to be making a lot of money anyways. But if you don't build up the habit of savings, again, whatever the amount is, does not matter. Building that habit, you're not going to have any capital to invest anyways. Right? And it's not really like in Canada, for example. I think it's kind of similar in the US, but in Canada, you cannot really borrow money to invest. You could borrow money to go get a mortgage and buy a house. You could do real estate depending on how much money you have, how much your income is. Again, that's something separate. But if you are going to be looking at, let's say, buying shares, getting into the stock market, the bank is not going to be loaning you money for that. So you have to save that capital that you need to do that. Now, of course, again, building the savings, making sure that, you're putting whatever you can aside, $20 a week, 20 a month, build the habit. It's okay. Start with 20, make it 50, make it 100, 200, 500, whatever. But make the habit, because once you have the habit, and it's one thing that, again, I might have talked about in my video before, but having the habit later on, if you're making more money, rather than you thinking, okay, now I have more money, let me go buy a new car, start paying finance or lease on that, then you're able to maybe adjust your savings first, then you can grow your savings, which in turn then you can grow your investment, which then you create more wealth and have more for yourself and passing down to the next generation, right? Rather than going and buying a brand new Tesla or brand new Mercedes. So making those decisions are going to be very important for you. So build the savings habits. Then when you have the capital to do investments, investing into companies that you understand, investing into companies that once you invest in them, you feel comfortable that, you're only going to check on them maybe even once a year. Right? I have a few different accounts, a few different brokerage accounts here that I kind of have for myself. Being in Canada, you can have like a tax-free savings, RRSP, which is like a retirement savings plan, and then just like a cash kind of direct investing account, which I have kind of all three set up. And some of them I haven't even looked in like 2-3 years. right? Like really looked into it and kind of see how it's been doing. Like I know what's the total economy is, how the overall market is, but I'm not worried too much to go in and look at it so often. My other ones, maybe every 2 months, every 3 months, that I kind of have my different holdings. I'll go just take a look at it, just kind of see what it's been doing. Some of them, because I also do like for my retirement, I have my own contribution set up. So it's like a pre-authorized contribution. So it's like before it was weekly, now it's like a monthly amount that gets taken from my main personal checking account and goes into this direct investing account, brokerage account, and sets it as cash. So once it kind of builds up a little bit, then I have to manually go in and make a sale, make a purchase of a company stock, right? So that's why then while I'm in there, I just look at my accounts and kind of see how it is doing. But I'm not worried about any of them because I've already done my research enough that I feel comfortable with what I'm buying. Of course, there's going to be new companies that's always growing. Again, there might be companies that are hot right now, but to me, I love boring companies. I love the banks. I love, McDonald's, companies that, especially, they have been around for a very long time and they have very good earnings per share numbers as well. And there's all these different metrics that I look at. But again, just bigger companies, well-established companies, names that, when you drive down your main street, you might see their stores, right? Starbucks, McDonald's, Costco, Apple, again, bigger companies, right? And it doesn't matter what somebody else tells you. It's like, oh, don't buy this company, I heard this, or don't buy this company, this other company is better, right? Take those as a hint. Don't take it as an advice, or don't take it as like the step that you need to take, an action plan for you, right? Someone might say, oh, I owned McDonald's, I sold it, and I have Costco, for example, right? Now, that might be okay for them, it might make sense for them, but it may not for you, right? So you could look at it, that's totally fine. They're giving you a hint maybe, or they're giving you their view, and sometimes that's okay. Sometimes it's good to kind of take another person or somebody else's view and kind of seeing what was, first of all, why did they do that, and then seeing if it makes sense for you to do it, right? And if it fits again with your investment strategy, your investment principle that you have. At the end of the day, it's going to be up to you to manage your portfolio, manage your investments, understanding the difference between investing and trading. So someone comes up to you and says, oh, you're investing, so isn't that like gambling? You're very confident and you understand the difference between them enough to be able to explain to whoever that may be. Might be a loving family or a good friend, but just because they don't know, they might come and say that to you. So you'll be able to kind of let them know and maybe even educate them as well, right? And with myself, I made many mistakes to be like where I am today. And where I am today, I'm still making mistakes. I'm not saying I won't be making mistakes. All I'm saying is that I just know enough that I feel comfortable with the investments that I have. And even with them, because sometimes I still lose money. Again, like I'm in no way perfect or got this figured out. I make probably way more mistakes than I should be making even. But still, you try your best. You try your best to understand how everything works and how you could take advantage of the news and of the things that happens around the world, at least to your advantage to some degree. So take that how you will. I hope that there's some value in there for you, because when I first started, getting to this investing, I was very interested in it even as a teenager. I've read many books on it, kind of like on trading, investing, and of course the big Warren Buffett, Charlie Munger, listening to the different like podcasts and even YouTube videos on how they invest, how they trade, and make sure you're getting even those that you're watching or the books that you're reading, making sure that whoever you're listening to can give you the proper advice and it's just not selling you something. That's also another good point. But again, it's up to you to figure out, because once your time passes, and it's easy to say, oh, I didn't know, no one told me, but your time has passed. And at the end of the day, is your responsibility to know. It might be hard to understand that, it might be hard to accept that, but you have to take charge of your life, right? And some of it might be taught in school, some you might hear in passings. If you go open an account at the bank, they might just really briefly just touch on it, and you might be like, okay, yeah, I'll talk about it later. But it's up to you to kind of go after it, ask questions. Your bank would be a great place to start. At the bank, they offer different solutions and different accounts and different products, but still it's a good place to start. So at least that way you get an idea. If you are going to the bank to kind of, again, get this information, make sure that you ask them about what the bank can offer you and what their brokerage accounts or their direct investing accounts are and how they can what they can offer you. Because when it goes to direct investing or those brokerage accounts, there's no advice being given. You are managing 100% of your funds. You're even in charge charge of putting money in and taking money out. You cannot even have them do it. You have to do that manually yourself at the branch. And even if you call in to like to direct investing with whichever financial institution or bank it is, they're not going to be able to tell you which company to buy. There's no advice being given. And even if you want to put a trade through with them, I don't know right now, but I think before it was even a higher cost. So if you were going to pay the $9.95, just a $10 commission, now it might be like 15 or 20 or 30 or something like that. Understanding the difference between them, again, being a good place to start. And then once you do want to actually get into investing or trading, finding the right books is going to be important. And that could just be a Google search away. There's a lot of different YouTube videos that even make recommendations on the books regarding investing, regarding trading. So making sure that you're understanding those and kind of comparing those for yourself is also a really good choice. Just take a look at it, see which one makes sense, choose an investment strategy that matches whatever it is that you want to accomplish, whatever that may be. Thank you for watching my video. Please like and subscribe. Leave any comments for any kind of videos or any kind of content you would like to see from me in the future as well. Take care, stay safe, and I will see you on the next one.